So we've completed our first section where we talked about planning, and what we need to do now is talk about the second section where we really get into understanding the financial cycle of the business and talk about monitoring financial position. By now you've reviewed the introductory material and you've got your case study out, Cascade Office Equipment. We'll be discussing that case as we go through this particular section, all right? In other words, we're really going to go inside the numbers, all right? We want to take a look at the numbers, and then we want to begin to tell that story of the business. But before we do that, I'd like to take a big picture view rather than the smaller picture view and take a trip through the business in what we call the financial operating cycle, all right? And that's where we'll start, where we talked about in our quiz the definition of net worth. What was it again, somebody? What was our core definition? Yes, when we talked about assets minus liabilities is equal to net worth. Now all I want you to do is visualize that as an equation. Add L to both sides. Assets minus liabilities, that goes away. Add L to the other side, and what have we got? Assets equals liabilities plus net worth. And when we take a look at that piece right there, that's the core structure of a company. An asset we know is something you buy. And you have to, in other words, something you own. In other words, in order to own it, you have to buy it. On the other side of the equation, what does that represent? The liabilities and net worth side. What does that represent? That represents the people who put up the money to buy those assets, doesn't it? Liabilities would be funds from whom? Let's start with net worth instead. Net worth, funds from whom? The owners, us. Liabilities, money from whom?
Lenders.
Lenders and vendors, right? Lenders and vendors. Anybody who's put up money, or if they sell you on a credit base, right? Anybody who sells you product on credit, it's just like they're giving you money, isn't it? So the bankers and the vendors, the lenders and the vendors, the owners, the lenders, and the vendors, they put up the money to buy the assets. And we call that particular statement what? Balance sheet. That's the balance sheet, okay? That's the one that most business owners are less comfortable with, isn't it? Now, why do we own assets? Why does a business own assets? You don't collect them. Why do they own assets? They own assets to create sales. We're going to build this financial cycle now. And why do we create sales? Why do we make sales?
Generate revenue.
To make a profit, right? And now we've got sales minus the costs, of course, will give us a profit. So in that part of the cycle, we've worked real hard to make a profit. Now what do you try to do? Hide it. Isn't that right? Nobody wants to pay tax on it. Well, it turns out you can run, but you can't hide. So you're going to pay some tax, and then we've got a net profit after tax. And what did we decide right at the end of our quiz that were the three things we're going to do with those net profits after tax? Number one, we're going to reinvest. Number two, we're going to repay debt. And number three, we're going to what? Take it home. We've now completed the financial cycle. See, we've got the arrows kind of going in one direction there, counterclockwise. We've now completed the financial cycle. What do we now do? Start over. That's exactly right. You start over. And when can you relax when you're running a business? Never. Someone said when you're dead. Sort of an oxymoron at best, right? Not terribly relaxed. You can never relax. Why? What happens? Technology changes. Social trends change. Population shifts. And that young person you bring in to teach them everything you know about the business, sort of the apprentice model, what do they do to show their gratitude? Was that said from personal experience, apparently? They go and start their own business to make you go away. When it happens to us, people say, boy, is that crummy. When it happens to someone else, we call it what? Capitalism. Exactly. It's kind of a Depends on who it's happening to, I guess. So that's one issue. 3 uses. Now, what I'd like to point out is, on your diagram, just cover the right-hand side. Put your hand over the right-hand side. What's the only thing you can see now? You can only see this, in other words, you can only see what? The P&L. Keep your hand over it. I didn't say you could take your hand off. So what can you tell me now about this business? You can't see what's on the right. You can only tell me what? You can tell me how he did last year. Isn't that right? And if you had a bad year, what do? Cry. And then you try to fix it. What's the saying in sports? Wait till next year. Isn't that right? We're going to get it together next year. That's what I said earlier when I talked about the nice thing about it is if you had a bad year, you try to fix it. You can rewrite this story. And we call that management, don't we? But you can only tell me what he did last year. Can you tell me how this company's done forever? You've got your hand over half of it. You can only tell me what he did last year. Now, move your hand to the other side and cover the profit and loss. Now what are you looking at? The balance sheet. Can you tell me how he did last year? No. But you can tell me how he's done forever. Isn't that right? Interesting perspective. So now, if you have a bad P&L, it means you had a bad year. If you have a bad balance sheet, it means you've had a bad life. A bad life is tougher to fix than a bad year, isn't it? And the fact is, from the banker's perspective, when I go in, when a customer comes in to talk to me, if I'm the banker, which of these 2 statements is the business community, all of us, more familiar with? P&L, would you all agree? The income statement. We're more familiar with the income statement. That's what we know about. When we go to conventions and everything, and there's people talking on finance, they almost always talk on the income statement. Why? Because nobody talks about the balance sheet. Why? Because it would be boring, apparently. Yeah. However, think about this now. We bring these statements to the financial community, to the bank. Which is the first one that any banker worth his or her salt looks at first? The balance sheet. Can you see the possibility for a disconnect or a misconnect as it relates to communication? We've got the financial community looking at the balance sheet. We've got the business community looking at the P&L. What happens when we communicate that way? Nothing, usually, right? You got it? And the fact is, we're both a little wrong. It's not the P&L or the balance sheet. It's the P&L what? And the balance sheet. There's another reason we need 2 of them. We talked about the key drivers of what again? Profits and cash flow. Where in this financial operating cycle will we find profits? Underneath which statement? The income statement. We can call it the P&L or the statement of earnings. I'm going to try to stick to income statement as we go through this course, but they're all synonymous terms. Under the income statement. So it's the income statement where we're going to focus on profitability. So what then would we need the balance sheet for? Cash flow. When you're out of cash, you don't look on the P&L. You look where? You don't look on the income statement. You look where? On the balance sheet. It may be the income statement that caused the balance sheet to be out of money, but in fact, we've got 2 statements and 2 items we need to track. Isn't that right? Income statement, profits, balance sheet, cash flow. 2 cycles, all right? We've now completed that cycle. You with me so far? And that flow, what we've identified here is a flow, is it not? That flow, what are we really trying to measure with those arrows that you see? It's going around, the owners and the creditors put up some money to buy the assets, we use assets to create sales, we create sales to make a profit, and the cycle continues again and again. What drives this flow? Well, first of all, what is it a flow of? It's not a flow of product. It's a flow of money. Can we measure flows of money through a business? We talked about wanting to measure. Can we measure flows of money through a business? Absolutely. And what do we call measures of money, flows of money through a business? We can call them cash flows in their generic term, but if we measure something on the income statement against something on the balance sheet, what do we call that when we've got two numbers?
Ratio.
Up against one another, a ratio. And we're going to be able to evaluate. And what are we trying to pick out of here? What are we trying to determine? Whether this flow is efficient. How efficiently is money flowing through this business? And we're going to be able to measure it against 1 year, against the next, against a third year, one company against a whole bunch of companies in your industry. In other words, a yardstick of comparison. There's a lot of ways. We'll eventually use these same ratios to measure against our plans. So we're really measuring efficiency, aren't we? Now, on the P&L, on the income statement, I've got sales and profits, right? What's in between? What's in between the top line and the bottom line? A whole bunch of what? Operating expenses, isn't that right? There's some cost of goods, leaving a gross profit, and then some operating expenses. If I had a whole bunch of line items there, what have I got? And then over on the balance sheet, under that term labeled assets, I've got three groups of assets, don't I? Those that are converted to cash in a year, I'm going to call them current. If they're more than a year, I'm going to call them long-term or fixed. That'll be more than a year. Things like buildings, equipment, all of that. And then if I can't figure out, I'll put it at the bottom and call it other. Liabilities. Those that are going to be paid in a year, I'm going to call them current. Those that are paid more than a year, I'm going to call them long-term. Fixed assets, long-term debt. Current assets, current liabilities. There's a parallelism here, right? And if I add water to this, hypothetically, and go boom, 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 and blow all these up, add all the line items, what have I got? Add all the line items, what have I got? Well, I've got financial statements, don't I? If I put in all the line items, I got financial statements. And that's where we want to begin our journey, is we've got to start with a set of financial statements. That's what we've done with Cascade. Now, you've reviewed the goals of this chapter, this section, and what we're trying to do here is focus on 3 or 4 key things. What are the things we're going to try to focus on? Our key learning objectives, what are they? Evaluate the financial performance of the business. Utilize the financial information, create a scorecard, and then create an analytical tool that we'll call a profit mastery assessment to evaluate how efficiently he's running his business and where the opportunities are to be better. You with me? So what I'd like you to do is take a look now at your case study, Cascade. First page. We've talked about Cascade Office Systems here. And what do we know about it? Let's just review the things we know about it. Number 1, it's an established business, right? Transferred from whom?
Father to children.
Father to mom and dad to daughter and son-in-law. They've developed what? A new product line. What is it? Revolving around custom office furniture for computers. They've also just gone through what? An expansion of the existing building. Isn't that right? They've gone through an expansion of the existing building. In other words, from their perspective, if we talk to them, what would they tell us about their business? Our business is growing. Now, when you're sitting on the financial side of the desk, what's grown? If they didn't finance the building with all equity, debt has grown. And now they have a bigger building. Isn't that right? They have more space. What do you do when you have more space? Anybody that's moved into a bigger house, what do? You fill it with what? Stuff. And that's a highly technical financial term, stuff, that refers to assets of all shapes and sizes, right? Stuff. That's exactly right. And they've got this new line they're going to focus on. And what's their strategy going to be? Any of you that have a marketing orientation, what have they outlined their strategy to be? Focusing on
Price and quality.
price and quality. I don't know if that raises any red flags, but sometimes it's hard to be a Mercedes quality with a Toyota product, isn't it? There's just a little bit of disconnect potentially there. I won't say for sure that that's an issue. It's just kind of a question mark. And why do we suppose, and let's imagine that they're here at the bank. Now, as we go through this particular case study, most of you are looking at this from which side of the desk? The business owner's side or the banker's side? The business owner's side. So what I'd like you to do for a portion of your time here, as we look at this, mentally transport yourself over to what? The banker's side of the desk. And if you're a banker, transport yourself over to whom? Where? The business owner's side. So we can get some perspective here on this whole process. And what do they need? The bank has called them in, and they're here because they need what? Money. They need money. And how much money do they need?
Just enough.
Just enough. Now, that's hard to argue with, isn't it? Just enough, unfortunately, is a little bit obscure, but we can be more specific than that, enough to get them over what? The hump, which is kind of an interesting visual if you let it go. Enough to get over the hump. Sometimes proving, if we refer back to that 80%, as the permanent hump. Huh? So that's where we find these folks, and what we want them to do, and we've got a whole, and the way we're going to help them now, let's be their consultants as we go through this. We've got a series of action steps at the bottom of that first page of the case study. And this is not rocket science, is it? This is not rocket science. 7 action steps. Let's just review them. First one, gather accurate financial information. What's the key word there? Accurate. And the acronym we might use from the computer world? GIGO. Garbage in, garbage out. Use lousy information and you'll make lousy decisions. And I can't tell you how common it is for business owners to have inaccurate data. If it's not accurate, timely, and put together in a format that is decision relevant, it really begs the question of whether we can use this information in the powerful way that we're going to. Secondly, package the information so you can see the relationships. In other words, structure is important. Laying it out in a decision relevant format is something we're going to do here. And this is not difficult. It's going to turn out to be pretty straightforward. Calculate financial ratios. What's the verb there? To measure. To measure. Now, which ratios will become apparent as we go through this exercise? Number 4, record industry composites. What is that? What's the word we might use? Benchmarks. Against, why do we want to measure against the industry? So we can know where you stand in relation to everyone else. And there's a host of sources of information that will give us benchmarking data. For some of our clients, we actually produce that data. They send us their financial statements and we produce it. Compare your results. And I have to say that this is normally where the action stops. And the two most important are the last two, aren't they? 6 and 7. Analyze possible causes. What caused it? Let's first of all identify the symptom, and then what do we want to ask? What caused it? Right? This is number 6. Analyze possible causes. If we can work our way back to the causes, and that's what we'll try to set up a format to do. And finally, what's the worst decision in business? Do what? Nothing. Do nothing. So do something, and when I say do something, formulate a plan. This process is going to lead us to think in terms of a plan. Implement it, but it won't always be right, will it? But it's better than no plan. And then, since we've just gone from item 1 down to 7, let's go from 7 back up to 1 and do it what? Again, let's monitor. And as I said earlier, if you were my customer when I worked in the bank, we'd do this twice a year. Why? I would make you, and you would like it. But probably not the first time. I know this because my banker was terrifically helpful in forcing me to do this, and he dragged me kicking and screaming into the process as well. And then once I got in, I found out what an amazing process. So what I'd like you to do now, we've got 7 action steps. I'd like you to turn the page and set your balance sheet and your income statement side by side. And I have an exercise for you. Here it is. It's not tough. I'd like you to look at those financial statements. And what I want you to do beyond looking, stop looking. I didn't tell you to look yet. I'd like you to look at them, and then I'd like you to each record what are the first 3 things you looked at. And I don't care what it is. You all brought a process with you. That's what I want to get a handle and my arms around is what's your process. And then when we get back together, I'll share with you my process.